to be working with Kurt on this webinar series and to talk through where we are in terms of this economic cycle and this economic crisis. I've entitled today's presentation, Return of the Economist. It's my theme for the year. That hasn't changed. I say Return of the Economist because we did not have a recession in this country during the previous decade. And that's unprecedented. We've never gone an entire decade without a recession, but bam, we turned the clock on 2020, the new decade, and here we are in this massive economic downturn. And so I want to walk through this. It's a Lord of the Rings themed presentation. I think you can tell that from this cover slide. And so lots of ways to start a meeting, of course. And thank you to Kurt for the introduction. But lots of ways to start a presentation. One, of course, is national anthem with an honor guard. Sometimes we, pray. Sometimes we recite the Pledge of Allegiance. I like the ring verse, which says, among other things, 3 rings for the elven kings under the sky, 7 for the dwarf lords in their halls of stone, 9 for mortal men doomed to die, 1 for the dark lord on his dark throne, in the land of Mordor where the shadows lie, 1 ring to rule them all, 1 ring to find them, 1 ring to bring them all, and in the darkness bind them. And that's the way I have organized this webinar, 9731. Some of you may have seen some of this content already, but there'll be plenty of new content in this webinar, I can assure you. I'm going to start out with, the really bad news. The Dark Lord has been at work in Middle Earth or America. So this is, you can see here, global cumulative confirmed cases. And I know there's been a lot of discussion recently about the number of new transmissions slowing in China and South Korea, for a time in Hong Kong, even in Italy. But this is where we are right now. I mean, this is through March 21st. It's parabolic. So we are at the very early stages of this crisis. And you can understand why public health officials are so concerned around the world and the United States. If you're looking for United States or US oriented data, well, here's some. And these red blotches give you some sense of where the coronavirus has spread first and foremost. And it's basically where people produce goods and services in large quantities. Europe, for instance, is completely engulfed. And as a region, that's the largest economy in the world, as it turns out. You can see what's happened in East Asia. Japan is the 3rd largest economy in the world. China is 2nd. And of course, in North America. And so, as I said, we're in the early stages of this. So imagine how these blotches are going to look in 2 or 3 weeks, based on the slide I just showed you. Again, just drilling down a little bit more in the United States, where do we see it? Well, we see it in large metropolitan areas. Chicago, New York, San Francisco, Seattle. You know this. This is why the economy is shutting down. And we'll talk about this, but in Boston, they've shut down significant construction projects. They've done some of the same things in Pennsylvania and in California, so on and so forth. So, even though sometimes these are, construction is deemed to be an essential business, and in much of the country, construction activity continues to varying degrees, the fact of the matter is the industry is vulnerable. And as we see more and more cases pop up, there are probably going to be more mayors and governors who are going to be asking the question, do we need to have construction activity right now? Can we pause that as well? And of course, the folks in Boston, the mayor of Boston, much to the chagrin of the governor of Massachusetts, has already made that decision, along with folks in Cambridge, Massachusetts, so on and so forth. Now, let's engage in a stroll down memory lane, shall we? Because one of the things that economists had said early on, when we were starting to get really concerned about this, let's say in February into March, at least from an American perspective, obviously the Chinese have been dealing with this for a bit longer. We call it COVID-19 for a reason. It was discovered in 2019. But it wasn't until March 9th that we Americans stood up and took notice in large measure. And I'll tell you why. That was the day, that Monday, March 9th, that the stock market hit the skids for the first time. We'll talk about the market today. It's up for a 3rd straight day, and that's great. We can talk about that. But Monday, March 9th, the Dow Jones falls more than 1,000 points. But prior to that, actually, the financial markets, at least the equity markets, were performing quite handsomely. And why not? The economy was spectacular coming into this year. And I have to tell you, as a forecasting economist, I was surprised by how strong the economy was coming into 2020. So in January, the nation adds 277,000 net new jobs, according to revised data for the Bureau of Labor Statistics. In February, we had 273,000 net new jobs. Phenomenal. Through February, jobs added for 113 consecutive months. And it just felt like the recovery was invincible. We just had this cycle going. So, more jobs meant more spending. And of course, this was especially true in the metropolitan areas where the economy has been strongest. And when you're adding jobs for so long, you drive down unemployment. And, you can certainly find small towns across America in which unemployment is high, or rural communities that have been affected by trade wars and low commodity prices, soybean prices trading around $9 a bushel, corn below $4 a bushel, so on and so forth. Yeah. But in major metropolitan areas like the boom towns of Dallas and Austin, Houston, Atlanta, Nashville, Boston, Seattle, and many others, that was where the action was. Over the last year for which we have data, Dallas added 3.2% to its job totals. Phoenix added 3.2% to its job totals. Unemployment down to 3.5%. You'd have to go back to December of 1969 to find unemployment as low as it has been in America. Now that's changing very swiftly, as you now know, but December 1969, that's a long time ago. Just to give you a sense of how long ago that was, the Orioles were good back then. That's a long time ago. And with more people working, fewer people unemployed, that was driving up wages. And if you're a construction user, what was your issue? Your issue was that the bids were coming in high. You weren't getting as many bids as you would have liked in some cases. Subcontractors were slammed. This is the growth in wages and salaries as measured by the U.S. Employment Cost Index. The fastest wage growth in about a decade in America, and we saw that among construction workers as well, particularly those in the skilled trades. And anytime you speak to a construction firm owner, they probably said things to you like, well, first they said, good morning, hello, how you doing? How about those Orioles? Shame about the Ravens, all that kind of stuff. But then, said, I still can't find electricians. I can't find heating and air conditioning professionals. I can't find plumbers. I can't find roofers. I can't find estimators. And I sure as heck, I can't find glaziers, superintendents, so on and so forth. Now, you might ask me, Anirban, you just said we had a 50-year low in unemployment. Why do we not have a 50-year high in the U.S. Employment Cost Index and wage growth? For instance, I noticed that during the previous cycle, the cycle of the 2000s, we actually had faster wage growth, retirement of baby boomers in large measure. So in many occupational categories, it is the case that one's compensation is a function of one's tenure. So, for instance, with local school teachers, just to use them as an example, local school teachers, they get their step increases every year, they get their cost of living adjustments every once in a while, and so the longer they've been on the job, the more they're being paid. But as those people edge into retirement in larger numbers, supplanted by members of Generation Y and now Generation Z, the millennials and now the subsequent generation, Generation Z, those folks have fewer step increases behind them, less experience, less compensation, and so you have that suppressing impact on wage growth. But I think you would agree it's been a strong market for workers. Amazon pre-crisis has raised its minimum wage to $15 an hour. Bank of America, $20 an hour. This is not done out of the goodness of people's hearts necessarily. These are for-profit enterprises. This is done as a reflection of how strong the labor market has been and how much they want to retain good workers and recruit new ones. So we have this demand-driven cycle in place. More people working, fewer people unemployed, more people making more money, more people shopping. This is retail sales. They're putting stuff in the baggins. You will notice, however, if you look at this last skinny bar here, which was February 2020, it may be the case. You'll notice that there's a bit of a dip in retail sales measured in billions of dollars in February relative to January. It is conceivable that that reflected in part some of this coronavirus issue. It's conceivable. It may just be seasonal, it might be other factors as well, but by February, maybe we're starting to see this in some of the data. The miracle, and we've talked about this before, at least I've talked about it with many of you, we enjoyed this 50-year low in unemployment. We enjoyed this more rapid wage growth and low inflation. I mean, I have to tell you, much of my last 2 years as an economist has been spent unlearning economics. Why? Because I had been taught in school, many of you had been taught, that when unemployment goes down, inflation goes up. It's the Phillips curve. And it's Econ 101 or 201 if it's macroeconomics. 101 is the microeconomic sequence often. The point is this, I mean, if somebody had told me a few years ago, Anirban, unemployment's about to fall to a 50-year low, and construction firms are not going to be able to find carpenters and electricians and superintendents and estimators, and manufacturers aren't going to be able to find enough machinists and welders, and trucking firms can't find drivers or mechanics. What's going to happen to inflation? I'd say, oh, inflation's going to go up. Phillips curve. But here's a very prominent measure of inflation, the core CPI, or the core consumer price index, all items less food and energy. And this measure of inflation, very prominently utilized, suggests that inflation has been running at 2.4% year over year. Of course, we now have deflationary pressures washing through the economy, but even before the coronavirus made its impact felt on the US economy, inflation was low, just a bit above, by this measure, the Federal Reserve's 2% target. We have not had a major inflation problem in America. In fact, there's another measure of inflation, the core CPE deflator, or sorry, the core PCE deflator. PCE stands for personal consumption expenditures, that suggests that inflation has been running at less than 2% year over year. Just remember this number, 1.6%. Below the Federal Reserve's 2% target. Justifying the not one, not two, but three rate cuts that were received last year in 2019 as we headed toward a 50-year low in unemployment. How does one predict such a thing? One would not have predicted such a thing. But that is a perfect environment for construction, isn't it? I mean, if you're a contractor, not if you're a buyer necessarily. Because I've got lots of people working. They are being accommodated in new office space. They're working in shopping centers. The demand for space is rising. I've got low cost of capital that supports development. So contractors would tend to be very busy during a time like this. And now, of course, the Federal Reserve has cut rates to zero. And one of the reasons that it's been able to do that, it doesn't have to worry about inflation. It hasn't had to worry about inflation. I mean, it was cutting rates when the economy was growing. And the Federal Reserve has basically said, we'll do whatever it takes. We'll do whatever it takes to help us get out of this crisis. I'll talk about why even whatever it takes isn't enough. I'll talk about that in a moment. But one of the reasons the Federal Reserve is able to cavalierly do this, set forth these policies of we'll do whatever it takes, is they don't have to worry about inflation. They haven't had to worry about inflation for a long time. Now, interest rates had already been, prior to the crisis, incredibly low. Now here I'm showing you the yield on the interest rate on the 10-year Treasury. And you might ask the question, you know, Anirban, why do you economists and why do investors fixate so much on the 10-year Treasury? And some of you, of course, know the answer to this, but the reason largely is because it's the most liquid bond in the world. So there's always a news cycle, isn't there? You might remember during the first into second week of January, that was the period of skirmish with Iran week. So we were waiting for the response from the Iranians that comes on January 8th. So during a news cycle, there might be some folks who say, I'm not sure how this is going to work out. There's a risk here. I'm going to de-risk my portfolio, at least for a time, and try to figure out what's going to happen. But I don't want to have all my cards on the table right now. I'm going to buy 10-year Treasuries. And I buy 10-year Treasuries in part because I know that they are always for sale because it's the most liquid bond in the world. January 8th comes and goes. The Iranians miss. Obviously, some US soldiers are hurt. We're sorry for that, of course. But from the perspective of the markets, you know, the crisis is behind us. I'm not going to move into the riskier part of my portfolio again. I'm going to sell 10-year Treasuries. And I know I can do that because it's the most liquid bond in the world. There are always people looking to buy 10-year Treasuries, whatever the economic circumstance. It's beautiful. Of course, you can have too much of a good thing, right? Because the demand for the 10-year Treasury is high right now. Why? And rates are low, therefore. Why? Because people are scared. It's a fear factor. Seems like a strange thing to say when the Dow Jones is up 951.60 points as I'm speaking to you. But there's still a lot of fear out there around the world. And I know some of you I've spoken to said, I sold out, you know, just last week, a week before last. And of course, the market has rebounded since. That doesn't mean it's going to stay that way. We'll talk more about that. The stock market is not the economy also. And I'm going to talk more about the economy than the stock market, that's for sure. As the market now is up 1,000 points, the Dow Jones at least. So, but anyway, from the perspective of construction and trying to perpetuate a growth cycle that had become sort of old in the tooth, you know, this is pretty impressive. Full employment, low interest rates, and you know, what that does is that creates more demand for various things, including housing. If you've talked to realtors lately, not very lately, but let's say back in January into February, they might have said things to you like, oh my goodness, I've got potential buyers coming out of the woodwork. The most common age in America this year is 28. The second most common age in America is 29. Third most common age in America is 27. These millennials are coming of age. They're forming households, they're getting married. They're not having kids yet in large numbers, apparently, because the US fertility rate is 1.73, the lowest fertility rate in America on record. Replacement fertility is 2.1, so we're well below that. But they are forming households, they are getting married, they're thinking about buying that house. First-time buyers are back in the market. And many of those realtors say, I've got lots of buyers, I have nothing to show them because the inventory of unsold homes has been so low. So when you've got strong demand and weak supply, what are you going to get? You're going to get rising property values. And that helps to trigger construction. And the kingdom has been under construction. This is residential building permits. You see that surge, late last year into early 2020 in residential building permits. This is home builders asking for permission, receiving permission to build. Home builder confidence until recently was at a 20-year high. This surge is largely driven by single-family permits. And that has been one of the weaker segments of the economy. Single-family home building. Much of the capital has moved into apartments. The apartment market has been very strong, obviously. But the single-family sector has been quite weak. But this is one sector of the economy that had been weak that was set to get stronger. And there were some others I'll talk about in a moment. Non-residential construction, this is non-residential construction put in place, spending put in place. And you can see, look at the last few months here, how lovely this was. Again, if you're a contractor. If you're a buyer of construction services, you might not be as impressed with this because it probably implies that there's more competition for the folks who would deliver your construction services to you. So many of you are trying to contain construction costs. In large measure, that might be your job, is to get value for the dollar. Well, it's harder to get value for the dollar when contractors are so busy. And as we know, there's some demographic factors at work as well. That there have not been enough people who have been willing to enter the skilled construction trades for various reasons. They don't have shop class in school anymore, so on and so forth. We don't want to get into that. That's too far afield. We're trying to focus on COVID-19 here, and I'm going to get to that. But again, this is a stroll through memory lane. Enjoy this part of the presentation. This is the best part of the presentation. This is the good news part of the presentation. You're going to hate the rest of this. If you look at spending growth, the non-residential construction spending growth over the last 5 years, let's say from January 2015 to January 2020, these horizontal bars represent the percentage growth in construction spending between January 2015 and January 2020. It's a comparison between the 2 months. So lodging incorporates or encompasses hotel room construction. Office speaks for itself, though that also includes data centers. And by the way, that would be one segment I would predict that will remain quite strong, data centers. And can you imagine how much new data we're producing right now as so many people are now ordering from or through DoorDash and Grubhub? And I'm not saying that wasn't happening before, but it's really happening now, right? I mean, imagine where it would be without the internet during the period of social distancing. We'd be even more isolated. Then we certainly wouldn't be together this morning. Hidden from view here has been a real pickup in infrastructure spending, not by the federal government necessarily, but from state and local governments, because state and local government finances have been healthy. But that's changing, isn't it? With so many people losing jobs, with retail activity affected, so that's fewer retail sales, taxes collected, that's less income taxes collected. I assume this will have an impact on property values, so you'll see that impact on state and local governments over time as assessments come in. Less recordation and transfer taxes collected as people cannot get to settlement. So there's all that. But prior to that, we had seen some chunky increases in spending in water supply, and that's not surprising. In a strong economy, state and local governments have more money, all things be equal, for infrastructure. We had that episode in Flint, Michigan several years ago, so many policymakers are aware that they have to address those circumstances. Public safety is the construction of prisons, jails, fire stations, police stations. And with wildfires in California and other parts of the country, there's been some focus on that, bulking that capacity up. Highway and street, again, not that a lot is going on at the federal level, but State and local governments have been picking up the slack. That's where we were. And then there's the stock market itself, which is up nicely today, but nowhere close to that 29,500 on the Dow that was roughly the peak achieved last month. So on the right-hand column, I'm graphing for you the Dow Jones. Left is NASDAQ and the S&P. You can see the recent dip, But, think about it, where we were in terms of this demand cycle. More people working, more people making more money. Their homes are gaining in value, of course, if they own a home. Their stock portfolio is gaining in value. Remember that joke during the financial crisis? Remember that? Oh, my 401k is now a 201k. No one laughed at that joke, by the way. I don't know if you ever told it. No one laughed. But then the 201k became an 801k. But between 2000 and 2002, and then again between 2007 and 2009, on each occasion, the S&P 500 lost roughly 50% of its value, which brings you back to a 401k, as it turns out, which for purposes of the Dow Jones, would put you at a little bit below 15,000 on the Dow. Now we're at 22,000 right now, and I hope we stay that way. And I hope this stimulus package really works, and we'll talk about the stimulus package in a second. But there is still downside risk. I hope people, I know people still appreciate that. Yeah, NASDAQ is up 3.63% right now, but we'll see where it goes. I know one thing, it'll stay volatile. And the so-called VIX, that measure of volatility, will remain elevated for the foreseeable future. And I have to say, I wasn't really clear why the stock market was rising before all this began to such heights. I'll give you some examples here. So again, we enter the year 2020 worried about the Iranians and the Americans. And during that episode, if you look at the charts, you'll see the stock market, whether measured by the S&P 500 or the Dow Jones, was still generally rising, even though there was some uncertainty. And then during the weeks after that, you might remember this seems like a long time ago, it was impeachment. Remember that? And the markets kept rising. And then we had the early phases of the COVID-19 crisis. And until March 9th, the Dow Jones sort of shrugged it off. All these other equity markets shrugged it off and said, not in America. But then on March 9th, the Dow Jones falls more than 1,000 points, as I say. But this section of the presentation is devoted to the fragility of the economy coming into this crisis. So a couple of factors here. One, not all industries were participating in the expansion, at least not fully, like manufacturing. Well, that's a major part of the US economy still. This is the Institute of Supply Management's Purchasing Managers Index. We've graphed it for you back to the year 2000. 20 years of data here. So you see the 50-yard line running west and east across the slide. Any reading below 50 means that manufacturing in our country is in recession. Now you can see where we were during the 2001 recession, the 08-09 financial crisis. But even for 5 months late last year, manufacturing was in recession. Why? Weaker global economy, trade war with the Chinese, strong US dollar, weaker US auto sector, which had peaked pretty much in 2016, and then of course the issues at Boeing. Now, what happened late last year? We get that first phase trade deal with China, the Chinese guaranteeing purchases of US soybeans and other agricultural commodities, American machinery, and energy. We get ratification of the USMCA, the US-Mexico-Canada Trade Agreement. A good agreement, by the way, in my view, for all of North America, as it turns out. So all of a sudden, some of the uncertainty facing the global supply chain had abated. And then we get some certitude, more certitude, regarding Brexit because of Boris Johnson's resounding victory late last year in the United Kingdom, which gave him more negotiating power with respect to the European Union as Britain pulls out of the European Union. So all of a sudden, by January, the reading on this index, as the global supply chain comes back to life, as does the US supply chain, pumps up to 50.9, rises to 50.9. But by February, of course, we're starting to really feel the problem with the shortage of components, other equipment from China. As the global supply chain is starting to take it on the chin, the reading falls down to 50.1. And now, my goodness, with global supply chains in tatters, given what's happening in Europe, for instance, a major center of throughput, as well as manufacturing of components, machinery, equipment. The German economy by itself is a juggernaut along this dimension. That reading is going to go well below 50. But there was a vulnerability even prior to the COVID-19 crisis, what I'm trying to say. Boeing was already in trouble because of the 737 MAX issue. And so almost immediately, Just a few days after the crisis enveloped us, Boeing is saying, we need $60 billion. Boeing has only one competitor in the whole world in terms of civil aviation, manufacturing of civil aviation equipment. One, Airbus, that's it. How many competitors do you have? Dozens? Hundreds? Thousands? I don't know. But a company like that was still fragile, even before the crisis really took hold. And now that fragility is fully exposed. But here's the big source of fragility. Here it is, indebtedness. Indebtedness. So, and one could make the argument that America has been growing for the wrong reasons economically. Here's what I mean. Let's do some math. Last year, the US economy grows 2.3% in real terms, meaning inflation-adjusted terms. I just shared with you a measure of inflation that suggests that inflation has been running at around 1.6% on a year-over-year basis, at least was last year. That's the PC deflator. If you add those two numbers together, what do you get? You get 4% nominal, roughly 4% nominal GDP growth in the United States last year. Let's do some more math. During last year's calendar year, during the calendar year 2019, as opposed to the federal fiscal year, America's federal budget deficit is $1.02 trillion. We, the American people, produced $21.7 trillion in output last year. If we do the math on that, that means that the federal budget deficit as a percentage of GDP was 4.6%. You take away that 4.6% deficit spending, there is no economic growth in America, at least not statistically. And these forecasts from the Congressional Budget Office come from before the COVID virus took hold. Well, I mean, on Friday, I presume that the House and Senate are going to get together, and they're going to pass a $2.2 trillion, or something like that, stimulus plan. The national debt coming into this period was already $23.5 trillion. Where are we headed here? $26, $27 trillion in the next few months? So that's a source of fragility, but it's not just the federal government. That's not the only source of fragility. This is bigger than that, because households have never been so indebted. Here I'm showing you various flavors of household debt. In orange is mortgage, in red is student loans, blue is credit card. In nominal terms, consumers have never been this indebted. Look at the red segment here, by the way, student loans. Look at how much it's grown over time. My goodness. I mean, this graph starts with 2003. That was not long ago. So yes, you've heard that even during very good economic times, you know, a bunch of Americans, you know, not quite half or in the range of half, could not afford a $400 unexpected expense. Well, how about losing your job? Can you afford that? No. And then corporate America has never had so much debt. You know, and that's a source of vulnerability. And this is what happens when you buy back your shares every year. You know, you issue debt to buy back the shares, debt goes up, equity goes down. This is what happens when you acquire your largest competitor. The mergers and acquisitions are often financed through debt accumulation. It's a source of vulnerability. So the airlines, you know, vulnerable. Boeing, vulnerable. Many businesses, small, medium, and large, vulnerable. And this includes, I believe, and I'm sorry to think this, construction firms. Right? Because construction firms during this whole period, they've been busy. They have plentiful backlog, or at least have had plentiful backlog. They've been busy. A lot of them will tell you last year was a record year for them. But record year in what terms? Revenues and profits, or just revenues? Because profits have been difficult to grow, in part because buyers remain quite aggressive in terms of trying to squeeze out, you know, margin. And because the workers are becoming more expensive, not to mention the equipment. So one of the issues here, you might say, if you're a construction user, and you are, many of you, say, look, now there are going to be more carpenters available. There are going to be more electricians available, more plumbers available, more superintendents available. You're right, there will be. Probably more leased equipment available too. But it's going to take some time for the atoms, those atoms that are floating around, these displaced construction workers, to the extent that that's happening, to find a new organization through which to supply their services. And one of the things that could happen here is that we see a loss in market share from smaller contractors, let's say smaller subcontractors, to larger ones, the ones with deeper pockets. And maybe, arguably, depends on their circumstances, greater survivability. But again, all of this relates to our fragility. Again, this notion that we haven't been growing necessarily for the right reasons. So this is a measure of labor productivity growth. It's a graph. I just want to point out to the second bullet on the right. U.S. productivity has risen at an average rate of 1.3% since 2007, compared with a 2.1% average since the end of World War II. Growing up, what did I hear as an American? That America's average rate of growth in real terms was 3% a year. That's what we would do, 3% a year. That's what I heard growing up. What do I hear today? 2%. In fact, I say that. I'm one of the ones that says 2%. What's the delta? Well, a lot of it's right here. Our workers not becoming as productive. And again, I think part of this is generational. The baby boomers are incredibly productive as a cohort. These are people who often entered segments like manufacturing, construction, logistics, because that's what they wanted to do. That was where their passion lay. So yeah, someone into financial services, someone into business management, so on and so forth. That's true too. It's an incredibly large and diverse generation. But they had shop class. You look at the average electrician, the average age is around 59, 60 years old. We haven't had as much entry. And if you're not passionate about something, you're not going to be as productive. So this is part of that fragility. There's, of course, always economic uncertainty, these risks out there. North Korea has not gone away. Recently they had 2 ceremonies for the new president of Afghanistan. You say, oh, that's so nice, ceremonies for the new president of Afghanistan. What was the issue there? It was 2 different people. One ceremony for one gentleman, one ceremony for another. One was Abdullah, and the other was Ashraf Ghani. And you know what happens in Afghanistan when 2 presidents are claiming to be president at the same time. That hasn't gone away. Iran hasn't gone away, so on and so forth. So now it is true that late last year, uncertainty, at least measured by this index, abated. Why? First phase trade deal with China. Some certitude regarding Brexit. Ratification of the USMCA. So we were set for a stronger manufacturing industry this year. We were set for stronger agriculture. We were set for stronger home building. So some of our weak points were going to turn into strengths in 2020. That's where we're headed. A pretty strong economy in 2019 was going to get even better in 2020. That was what our destiny seemed to have been. But now with global supply chains falling apart again, with so much global economic weakness, so much political turmoil in various parts of the world, this uncertainty is going to rise again. And then another source of fragility was the fact that asset prices were high coming into this period. This is a Shiller price earnings ratio. Graph back to 1980, so I'm showing you 40 years of data here. So this is trying to get at the share prices of the S&P 500 vis-a-vis the underlying corporate earnings. And corporate earnings actually in this country have not grown for the last 6 or 7 quarters. Stock market kept rising for a time, but corporate earnings had not been growing. And so what happened, the price earnings ratio kept rising and rising and rising. And you'd have to go back to the period just before the dot-com bust that began in March of 2000 to find meaningfully higher asset prices, at least as measured by this indicator. Fragility. Now, don't get me wrong. It was a great decade for the Americans. For decades, our share of global output was falling on purpose. It was the Americans who fashioned the Marshall Plan to help rebuild Europe post-World War II. It was the Americans who invested their own treasure to help rebuild the Japanese economy after World War II, trying to turn our sworn enemies into our future trading partners, and it worked. Germany is today the 4th largest economy in the world. Japan is 3rd. But last decade, something different happened. America's share of global output actually rose from 23% at the beginning of the decade to 25%. And we Americans, in many ways, are miracles. We are home to less than 5% of the world's population. We're home to a quarter of its output. I'm going to say something here that might sound a bit cheesy, a bit patriotic, but I really believe that you can make a case that we, the Americans, are the least messed up people on the planet. I know, very strong. But you can see why, right? Oh, don't get me wrong, we're a mess with our deficit spending and so on and so forth, our domestic politics, our ill-defined immigration policies, so on and so forth, all of that. We're a mess, don't get me wrong. But we might be the least messed up in the world. But does this performance, as heady as it was during the previous decade, justify this performance. This is stock market returns by country, 2010 and 2019. Our markets returned 256%. The emerging markets, which tend to grow faster than America, 49%. India, which grows 5 to 6% in a bad economic year, 46%. So whether you're looking at absolute terms, measures like the Shiller price earnings ratio, or in relative terms here, this was a source of fragility. And now this fragility has crashed into COVID-19, which is a very different phenomenon than what we experienced in 2008 and previously. Why? Why is it so different? Well, number one, this is supply shock. And a supply shock does not respect the momentum of the economy as it had been. Because the economy as it had been was really a demand-driven economy. But when you've got containment measures like quarantines, travel bans and restrictions, closure of public places, people not being able to go to work, including now, in some cases, construction workers, that's a supply shock. Factory closures and cutbacks and service provision and supply chain disruptions aplenty. So the Federal Reserve can do whatever it wants. It's fine. And you could have a stimulus package equal to roughly 10% of annual US GDP. $2.2 trillion, if that's what the stimulus package turns out to be, is almost precisely 10% of US GDP. That's great. But it's a supply shock. So who cares? It's not the Federal Reserve. It's not Congress. It's the folks at Regeneron, Gilead, Pfizer, Merck, Bayer AG, the brilliant minds at global life sciences enterprises. They need to find a cure. They need to find a vaccine. I know a lot of us are hoping that hydroxychloroquine turns out to be a good cure. That's a medicine for malaria, lupus, rheumatoid arthritis, some other ailments. Testing going on a daily basis. And at some point there will be a genius who strikes it and finds it, figures it out, and we got it. And hopefully sooner rather than later. But it's a supply shock. Now that supply shock produces a demand shock. That's true. So when I lose my job because my employer, they can't invite customers into the restaurant anymore, or whatever, or they can't invite customers into the store anymore. Now that becomes a demand shock. I lose my income, I lose confidence, so on and so forth. But ultimately, the reason that this economy fell apart so quickly is that the nature of a shock is a supply shock, not a demand shock. See, in 08-09, when we had that financial crisis in 08-09, what happened? People stopped paying mortgages in many instances. We had the subprime mortgage crisis, so credit dries up as bankers don't want to make more bad loans. We have obviously things like Bear Stearns and Lehman Brothers and Freddie and Fannie and so AIG, all this. So if liquidity was the air in the balloon comes out. We lose that liquidity. But then what do you do then to solve that crisis? You put air back in the balloon. You have the Troubled Assets Relief Program, TARP, you recapitalize the banks, you cut interest rates to zero, you engage in quantitative easing, you drive the Federal Reserve's balance sheet from $800 billion to $4.5 trillion. You put air back in the balloon, and guess what? That spawns the lengthiest economic expansion in American history. One that was going to be great in 2020 as well. But the fragility is what? All that debt. Because what are you trying to do? You're trying to keep interest rates low so people borrow and spend, borrow and invest. So we come into this period very fragile. It took very short order for the economy to fall apart. And the cure is not really a demand-driven solution. It's a supply-driven solution. The global economy, of course, coming into this period was already fragile, not just the US economy. We economists have been quite slow to realize how bad things are and will become. We're starting to get it now. But I'll give you an example. The International Monetary Fund employs more economists than any place in the world. And I'll talk about the second bullet. Just a couple of weeks ago, the International Monetary Fund said the following: the IMF now expects 2020 world growth to be below last year's 2.9% rate. Tell me something we don't all know. But that's where we were. Now, 2.9% is pretty bad. But as we know, it's going to get much worse. Many economists now forecast that COVID-19 will inflict greater economic pain than they had previously expected. Well, that's an understatement. The Morgan Stanley expects a 30% decline in GDP during the second quarter. Bank of America, 25%, so on and so forth. The second quarter of 2020 will be the worst quarter of our economic lives, at least statistically. I hope you fare well. I hope I fare well. But from the perspective of the macroeconomy, it will be the worst quarter of our life easily. Look at this bullet on the top of the right column here. By comparison, during the worst quarter of the Great Recession in late 2008, the economy shrank by 8.4%. We're talking about 30% in the second quarter. Now, I think you'd agree the Great Recession was pretty tough, especially for construction. We're talking about something, not an order of magnitude worse than that, but something really quite dire. This comes from Oxford Economics. So you see the blue line on this graph, the dark blue line, that's the forecast for world GDP or global GDP, global output, as of January. The red segment there at the end, that's February's forecast. And you can see how it changed. But what do you see there? This is key. What do you see there? You see the letter V. You see the letter V. And this is important because I can tell you that though this period is going to be quite dire for many Americans, and there are going to be many business failures, and I think when we wake up from this crisis, you're going to see a lot of empty storefronts that are going to stay empty for quite some time. But there will be parts of the economy that will race back, because that has been the experience based on previous pandemics. And I know this pandemic is different, I get that. But this graph gives you some sense of the shape of recessions and recoveries from prior pandemics. So too many lines on here by half, but you see this light blue one? This light blue line that goes way up and then comes back down, that's SARS, Hong Kong, 2003. SARS, Hong Kong, 2003. The 0% line there going across, that's the pre-existing average rate of growth over the year prior to the outbreak. So what happens? Economic growth slows relative to the prior year in every case. But then what do you see here? In many instances, a V-shaped expansion. You know, the average episode saw a GDP hit of 4 to 5%. This one will be much bigger, you know, during the initial 2 quarters after the outbreak. This will be much bigger. We just talked about that. This is a different magnitude. This is different in magnitude, but it doesn't have to be necessarily different in nature. So we have a sharp downturn in economic activity through the second quarter, but then thereafter we might expect to see, in fact, I expect to see a sharp bounce back in economic activity, a V. Now, we're on the wrong side of that V right now. As you know, today, the government released initial unemployment insurance claims. The figure, you can see bolded there, roughly 3.3 million. The previous week, it was a bit above 280,000. The week before that, 210,000. So I've graphed that for you here. And by the way, not everyone who becomes unemployed files for unemployment insurance. A lot of people do not. So we started this period nationally at a 3.5% unemployment rate. My guess is by the next quarter, you know, we will be looking at 12%, 13%, 14%, 15% unemployment in this country. The peak during the Great Recession was around 10%. It's going to get really, really ugly. And I know checks are coming and so on and so forth, that's going to help, but it doesn't really change GDP that much. Think about it this way. It helps, you know, the stimulus helps the payments side of the economy, which is important. So let's say I get a $600 check from the government, great. And I pay my rent, great. How much wealth has been created? It basically what happened, the federal government paid my rent or my mortgage or part of my mortgage or part of my rent. But I still can't go to work. So in terms of GDP, in terms of output, the payment is fine. You don't create any more wealth though. You just have a transfer of $600 from the federal government to my landlord. See the problem? It's a supply side problem, not a demand side problem. And the landlord might still find that despite the fact that I sent in a check, a lot of people didn't. So they're going to have financial issues. And I still have uncertainty because that was my one-time check. Now there has been some additional monies for unemployment insurance, so on and so forth, above what states pay coming out of the federal government's budget. Yeah, fine. And that helps the payment side of the economy. Do not get me wrong. And loans to small businesses, you know, they help. They're going to help. But I mean, look at this. I mean, how many workers are we going to lose in this cycle? I mean, an unemployment rate of 15%, I might be undershooting vastly. So if you look at recent data, and this comes from the Federal Reserve Bank of St. Louis, in terms of All occupations, total employment, 144.7 million. Employed in occupations at low risk of layoff, that first bolded row there, 77.9 million. Let's call it 78 million. But let's look at the next bolded row. Employed in occupations at high risk of layoff, 67, not quite, million, or 46% of total employment at high risk. 46%. And not to get political here, but one of my fears had been that, while the economy was good, states and localities raising minimum wages, not problematic. Whether $50 an hour in certain West Coast cities, $11 an hour in my state of Maryland. People have been in demand. So it does not seem to have really impacted job growth or job creation in America. So I'll give you an example for my state. In my state, the unemployment rate in January was 3.3%, Maryland, the great state of Maryland, the free state. At that time, we had, as of the week ended February 29th, we had initial unemployment weekly claims of 2,626 per week, at least for the week ended February 29th. That's what we've been running. For the week ended March 21st, this last week, 41,882 Marylanders filed for unemployment. So one of the issues here is these local unemployment offices. These are claims that have been filed, but they've now got to look through the claims and see which ones are valid. Make sure there's not fraud. I mean, these offices have been set up for 2,600 claims per week, not 42,000. There's all kinds of issues created by this. The cure, of course, is so different because it's a supply shock. You can increase resources to the health sector. That's number one. We need to find a cure. We need to treat people. We need and flatten the curve, as you've heard on every single television station. My goodness. Yeah, it helps to expand liquidity to firms and expand liquidity to banks. I'm not saying that those demand side measures don't matter. They matter. They're going to help mitigate this to an extent, but ultimately, got to get people to work. You appreciate this. You appreciate this. The U.S. government response in terms of this negotiated deal. So draft legislation to establish this $2 trillion plus stimulus package. The House will take up the measure on Friday, later this week. Direct payments of $1,200 to most American adults, among other payments. Some of you, of course, will not qualify for this. You make too much money. Expanded unemployment insurance benefits. 4 months of full pay raises the maximum benefit by $600 a week, on top of the usual $200 to $550, depending on the state, in terms of their generosity with respect to unemployment insurance benefits. More than $150 billion for the healthcare system. That's terrific. Hospitals, research, treatment. $150 billion to state and local governments. I wish that was a bit more, as it turns out. Why? Because state and local governments have to balance their budget every year. So as I say, they're seeing fewer revenues right now, and they're cutting back, as it turns out, on services like street cleaning in Washington, D.C. I don't want to see that happen. These need to be pillars of stability for the economy, state and local governments, to have capacity, to keep people employed. But $150 billion is not chump change, do not get me wrong. I then throw out $50 billion in the form of loans to small businesses, which I'm a small business owner, so I appreciate this, and I probably will apply for one myself. But again, got to get people to work. You understand this. I'm not saying rush people to work. I'm not saying that we shouldn't, be barricaded in place and so on and so forth. That's a different issue, a political issue, and so on and so forth. But there will come a time, by the way, when there's going to be a real difficult choice or decision made by policymakers about when is it okay to go back to work. I mean, do we have to have 0 COVID-19 cases to go back to work? I mean, what is an acceptable loss? I think that's a fair debate, don't you think? I mean, you and I drive to work, a lot of us, or we take a train. There's always risk. People die in the shower. So at some point, we're going to have this debate about, when is it okay for us to re-engage each other? It's going to be interesting. And we'll see. So that brings me to my final slide, the one forecast, and then I'll move to questions or addressing your questions. Look, this is obvious, but I have to tell you, a lot of economists, up until a couple of weeks ago, were still thinking we might be able to avoid recession. I mean, are you crazy? Recession has already begun globally in the United States, and I still expect it to be short and vicious, which is how my wife characterizes me. I'm pretty sure about the vicious part. I'm not sure about the short part, because that's an epidemiological issue, right? But we do have the best minds in the world and work on this. These are people who dealt with Ebola and H1N1, who've dealt with things like HIV and other things. Short and vicious, because the world's life science community is focused on this right now. And there are a lot of brilliant minds, high IQs in that population. The best positioned people in this economy work in the public sector. They generally enjoy greater job stability. Not to say that they'll be completely unaffected, but the private sector workforce will be hammered. That much I know. And unemployment will soon be greater than 10%. Will it peak at 50%, 20%? I would think something like that. In my state, I've been saying I think it'll peak at 11 to 14%. I might be too low. We have a big federal government workforce, so we have generally more stability than other places during times of economic trauma, but we'll see. Our collective expectations as economists are steadily adjusting to the downside. We still haven't caught up fully in terms of how bad this is, because we've never seen data like this before. 3.3 million initial unemployment weekly claims. Almost nobody predicted that because we just haven't. That's not part of our experience. When Goldman Sachs said a couple of weeks ago it was going to be 2.25 million, a lot of people said, "Oh my goodness, that sounds so high, impossible." We were a million above that. And there are going to be more people who are going to file next week and the week after that, so on and so forth. But let me end on a very positive note here. When it commences, the recovery from this crisis will be sharp, profound, and most welcome. Look, we've got a lot of stimulus in the pipeline, and interest rates are low, and there's a lot of pent-up demand, right? For all kinds of things that people are not buying right now, whether it's homes or cars. There's going to be a need to rebuild inventories when General Motors, Ford, and Chrysler, BMW shuts down all or some of their plants. And to the extent that people are still buying vehicles, the inventory can only fall at dealerships, can only fall. So all of a sudden, when we're able to re-engage with another, and people are saying, I was looking for a car before, and I'm still looking for a car, you're going to see a lot of pent-up demand. And all of a sudden, the dealerships are going to look to their manufacturers and say, you know what, I need more Ford Mustangs. I need more F-150s. And so all of a sudden, the orders to the manufacturing sector are going to surge. And then remember, we have that first phase trade deal with China, the ratification of the USMCA. We've got some pent-up demand there, and maybe even pent-up supply. So there's going to be a need to rebuild inventories, a really sharp inventory replenishment cycle. And then, of course, people are anxious to meet again, go to restaurants, see a movie, watch the Baltimore Orioles, which is the most beautiful thing a human being can do short of nurturing a child, and engage in other most wonderful of human activities. And that's been the experience previously in various societies affected by SARS and MERS and H1N1 and Ebola, sharp bounce back. So when it happens, it's going to be profound, it's going to be most welcome, and I hope you enjoy it when it comes. We're not there yet, we're on the wrong side of the V right now, and the point on that V may not be especially sharp, I'll agree with that, but it's not going to be a U, it's going to be a V-shaped recovery, and you're going to love it. So thanks a lot. Please follow us on Twitter or so on and so forth, and I thank Kurt for the opportunity to be with you today, and I'll give way at this time.
Thank you, Anirban, and I'm going to thank you, Anirban. And I'm going to suggest you peruse the chat box there for the questions. There are several good ones, and if you wouldn't mind keeping the microphone, your microphone open in the video, we'll invite you to answer some of the questions that have been coming in throughout your presentation. Back to you, Anirban.
Right. So a question here: which should we expect full recovery for business owners? Oh, I think it depends on the business. So Amazon's already fully recovered, right? They're hiring 100,000 people, and Kroger is hiring thousands of people. I mean, there's certain companies that really haven't suffered very much from this, are not expected to suffer very much from this. But for the most businesses, it's going to take a long time. And I think that one of the hardest hit sectors will be commercial real estate. And one of the reasons for this is because a lot of people are going to miss those lease payments. A lot of people are going to close up their businesses. The commercial real estate folks, managers of buildings, for instance, office buildings, can try to chase after them in bankruptcy court, so on and so forth. But there's not going to be anything there. So you're going to see a lot of empty storefronts. It's going to take a long time for American entrepreneurship to build back and to cause vacancy rates to fall and occupancy rates to rise to normal levels. But it depends. But it's going to take a while. It's going to be a V-shaped recovery. But remember, the way down on the V is very, very sharp. So 2 years, 3 years for typical businesses would not surprise me at all. Another question, can we please get these slides emailed to us? The slides are going to be made available to you, so
Yes.
you don't have to worry about that. Were the job numbers, the 3.2 million downturn today, already baked into the market? The market Dow Jones is currently up nearly 1,000 points. That's a question from Herb. Let me answer this question. So the number was a bit above actually market or consensus expectations. So 3.28 is close to 3.3 million in initial unemployment claims filed for the week ended March 21st. But was that number baked into the market? Not fully, but here's the irony. Here's the irony. And we see this often in the stock market. We see often that a bad economic number is treated in the equity markets as good news. So the markets have already priced in a recession. So that was that big 37% dip that we saw in the Dow and the S&P when we moved from roughly 29,500 Dow to a bit above 18,000. That was the recession being priced in. Since that time, what has been priced in? Because we've seen this, racing higher now to 22,407. The stimulus package has been priced in now, the $2.2 trillion or whatever it's going to be. It's going to be roughly that. And what today's lofty initial unemployment claims number reveals is that businesses are being more aggressive laying workers off than the market had thought, which is awful, of course, from the perspective of the American economy. But if the game here for many businesses is to preserve cash, to stay liquid and not just solvent, then the market looks at that and says, okay, CEOs are being very aggressive in cutting costs. I believe in the staying power of American corporate sector. I'm going to buy stock. And so the Dow, as I'm speaking to you right now, is up 1,194.6 points. And I think in part it's because the news was worse for the economy, but then better for the economy. Another question here. What is your thought on current oil prices and time to recover? Will it recover in a V fashion? It will recover in a V fashion. Now, as you know, part of this is external to COVID-19. Does it surprise anyone in this world that we live in that Russians and Saudi Arabians can't get along? Who gets along with Russians anyway? I'm not even sure, but maybe other Russians, but that's about it. So I don't mean any insult, but we love Russians. No, we don't. Anyway, the point is this: I'm getting $23 for a barrel of oil today, and a lot of that is because the market had been expecting an agreement between the Russians and the Saudi Arabians, so-called OPEC plus nations, to constrain the supply of oil. And we know that the Americans have all this shale production going on and all this capacity. So the world has been full of oil. It's full with oil. And so oil prices were low coming into this period. And then, just as this was becoming more serious in North America, this COVID-19 crisis, the Russians and Saudis announced, we can't make a deal, we're supplying to the hills. So oil prices plummet. And what they're trying to do, as it turns out, the Russians in particular, are trying to impose pain on the American shale producers. They're trying to drive them out of business. It won't work. We're Americans. You can't drive us away from anything. And so what you're going to see at some point is the Saudis and the Russians, having done a lot of damage to themselves in this manner, are going to somehow make an agreement. Oil prices are going to start to rise, and the economy is going to start to pick up as people start going back to work around the world. When America, another question, when America goes back to work, do you see a large infrastructure legislation package being approved? We need to be better prepared for future pandemics, and that includes a strong infrastructure program. I could not agree more with that assessment. And I also think that the infrastructure program is coming to America. Again, one of the issues here is, what about the national debt? Well, it's out there. But we know that we Americans have really lost out in terms of becoming more productive, that our infrastructure is no longer world-class, that the American Society of Civil Engineers rates our infrastructure a D+, that no category of infrastructure out of the 16 categories that they measure gets above a B. The highest grade is for railroads, of all things, and railroads includes, for instance, Amtrak, and that gets a B. So we've got some issues here. We need to address these issues. We're going to have very low interest rates facing the federal government, extraordinarily low rates of borrowing on federal treasuries. In fact, what they should be doing right now in Washington, once they pass the stimulus package on Friday, is coming out with an infrastructure package. Because I don't know that the federal government is going to ever face such low borrowing costs again. Interest rates are going to pop one of these days when the bondholders get concerned about the federal government's ability to pay this back in a timely fashion, about not getting a haircut. And so right now, starting Monday, give them the weekend, fine. But starting Monday, they should come out with an infrastructure package, and we need to put a lot more into rail and airports, roads and bridges, and tunnels, so on and so forth, flood control, and there's a lot there. So that is a great question. When does personal pain outweigh the virus? Oh, well, this is the question of the day. Because you can imagine the following scenario occurring. This question comes from Kevin. What happens when we go back to work during the summer, that in fact these rumors that have been circulating around that when it gets hotter, the virus will sort of dissipate? I'm hopeful that that's true, or that we'll find a vaccine, or that we'll find some kind of treatment. But what happens if we don't find a vaccine, and by the fall, as the weather cools, we start to see a reoccurrence of COVID-19? What do we do then? Do we shut it down again? Or do we create some rules about acceptable loss, which is a sort of military jargon? I don't know. People die commuting to work. People fall in the shower. We have train derailments. People get the seasonal flu. And yet we still go about our business. Now, we know that we can't do that right now, go back to our business, because the health system would be overwhelmed by new patients. So that's a consideration now. But at some point in the fall, we might not be worried about that, but we might be worried about contamination. And do we have to barricade ourselves in our homes again? It's going to be tough. We need to have this debate now. What are the parameters here? I mean, and at some point, the policymakers are going to have to say, look, we have to get back to work. We have to get back to doing what we're doing. There's a risk out there, but we're going to have to get back to work. And it's going to take real adults to figure out how that works. What category of projects, public sector, do you expect to continue but with extended schedules? And what sectors, oil and gas, do you see canceled projects permanently? And where's the middle ground? Look, there's going to be a lot of postponements, of course, of projects. And some of that is forced by the government in Boston, by the Commonwealth of Pennsylvania, by the state of California, so on and so forth, on certain projects, commercial projects in particular. But, look, these governors, mayors, county executives want people to get to work as soon as possible. And that includes construction workers. So the public sector is going to get back to work as quickly as it can, getting these projects started up again. Now, look, if you know anything about construction, it's complicated. So you just don't go from 1 to 0 back to 1 that quickly. It takes time to get things started back up again. I understand that. But I would expect public construction to bounce back quite quickly. And in fact, that's going to be one of the sources of stability through this whole thing, because you're going to see a lot of public projects continue on. That would be my prediction. Not in Boston necessarily, but in other places. With respect to oil and natural gas, if I'm right, and by the way, natural gas prices have also fallen during this period, around a little bit higher than $1.60 per million BTU. But if I'm right that it's a V-shaped recovery in oil and natural gas, then you're going to see that drilling activity pick up pretty quickly in the oil fields. I mean, those private sector operators in Texas, Oklahoma, Louisiana, New Mexico, North Dakota, Alaska, they move quickly. I mean, they're trying to measure profits in quarters, so they move quickly, and they're going to have to replenish revenues, aren't they? Because right now they're bleeding cash. So I think that comes back very, very quickly. Let's see if there's any others here that we can address or want to address. Please comment on this hypothesis with respect to construction. We will see a spike in construction once we are past COVID-19. Then we will see a lull because new projects will be delayed, and then we will see steady rise thereafter. This question comes from Marty, and Marty may be a genius, because this is exactly what I expect to see. Marty and everybody else, what I expect to see is that, look, construction in Boston, Pennsylvania, California, other places really picks up. Again, once you get all the atoms in place and the organizational structure back in place, it takes a little bit of time. But once that happens, you'll see construction race back. But then, Marty, we'll have some structural issues in the economy, won't we? We'll have even more indebted parties in the economy, more struggling small businesses, right? That they will have received their stimulus loan and so on and so forth. And they've tried to lay off some workers, but now there'll be a period during which they're trying to hire back workers. They're trying to collect overdue rent, all this kind of stuff. There'll just be a lack of economic vigor. So I expect this: sharp downturn, sharp upturn, and then the economy softens thereafter quite meaningfully to below average growth for a while. Is it 3, 4, 5 years? That would be my guess. And we've seen this in other societies, by the way. If you look at that one graph I showed you of recoveries from previous pandemics, there was this initial V, and then the economies after that flatten out because there's still some residual structural issues in the economy. And, you know, here's one of my fears. And this is my last point on this question. But here's one of my fears. Will we ever feel comfortable again? Will we ever feel comfortable again with a strong economy? In other words, there'll always be, it seems to be in the back of our mind, yeah, it's good today, it could be bad tomorrow. I just don't know when it's going to happen. And will we ever get to that kind of frothy economic growth that we saw in the late 1990s? Or, you know, during much of the past decade, you know, where it felt really good. Didn't it feel really good to be part of this? It did. But now, will there not always be this feeling, this fear, you know, that just behind us, just a day or two away, will come another crisis? And so we just cannot never be as aggressive in terms of investing and borrowing and merging and acquiring as we have our building. I'm worried about that this will have a very long-term impact on our average rate of growth. But look, enjoy the V-shaped part of the recovery. And I'm just speculating on the rest after that. Are there any other questions here?
Anirban, can you hear me?
Yes, I can.
Quick question that some have come on my text, and that is, what industry sectors do you think will be almost eliminated, perhaps? You know, there's hotels, there's shipbuilding, there's the cruise line industry, et cetera. And what industries should we keep an eye on in terms of outrageously healthy and rapid growth? Any comment on that?
Sure. So I think as long as we have senior citizens, we'll have a cruise ship industry, as it turns out. But it's going to be decimated. Actually, the word decimated is misused in some sense. Decimated literally means to reduce by 10%, but we use it more broadly than that. Yeah, these cruise ships seem to have the reputation as being petri dishes for disease. And even before COVID-19, that's going to be a, you know, whether it's Carnival Cruise Lines or others, they're already in trouble financially. And we've seen some cruise lines already fail in Europe and some other parts of the world, Japan. So I think that's going to be a sector that's really going to have a tough time bouncing back. There certainly will probably be individual hotel chains, smaller ones, that will struggle, but I would expect to see a Hilton and a Marriott, you know, and so on and so forth. At the end of the day, we still need hotels because we'll still go have business travel and still want to meet face-to-face and so on and so forth. In terms of the strongest industries, healthcare. Because the game in healthcare for a long time in America has been what? Minimize costs, get lean and mean. We're trying to drive down the cost curve as much as possible. And, you know, one of the reasons that we don't have enough ventilators, gowns, masks, so on and so forth, ICU beds, is, you know, we're lean and mean. I'm not saying that we should be building empty hospitals waiting for the next crisis, not at all. But what we should have is a plan for, you know, robust expansion of the healthcare system when we need it. And the military should be part of that, of course. You know, building temporary hospitals and so on and so forth, which they can do very, very quickly and efficiently. Turning convention centers and arenas into, you know, places where you can have 500 ICU beds, so on and so forth. And of course, the construction community, you know, relates to that very neatly because, you know, if you're talking about turning a stadium into a hospital, well, the electrical needs of a stadium are very different from the needs of a hospital or the plumbing needs, so on and so forth. But you've got to have that capacity on hand. So one is healthcare preparedness. That'll be a big industry. Second, data centers. My goodness. I mean, more and more of the economy has moved online, so you're going to need even more data centers. Obviously, this has been a big source of demand for contractors previously, whether in Northern Virginia or other places that have become home to a lot of massive data centers. You're going to see even more of this going forward. Enterprises like Grubhub and DoorDash, you know, food delivery services, and delivery services generally. Amazon gets bigger because of this. I mean, the folks in Washington, I gave a webinar yesterday to folks, you know, in the Washington, D.C. metropolitan area. And if winning HQ2, Amazon's HQ2 second headquarters was important for them before the crisis, imagine how important it is to win it now. And imagine the cost to New York not keeping that headquarters because they were the other winner, but they unwon. In any case, you know, there are going to be winners and losers. U.S. manufacturing will be a big winner. Domestic manufacturing, reshoring. Why do I say that? I say that because you want certitude regarding your global supply chain. And this is another reason not to depend upon East Asia for meaningful parts of that supply chain if you're an American business. I think you're going to see an acceleration of reshoring, even with that first phase trade that started with the Chinese. You're going to see more reshoring of American manufacturing.
One of the questions that's come in, Anirban, on my text is, I saw gas at $1.65 today, and I thought that's not good news. So how does the global oil economy come into play, considering not only COVID-19, but OPEC and all the other impacts on that? What do you think those guys are thinking these days?
Well, I think thinking it's an existential issue for them, right? Some of these economies, like Saudi Arabia, depend almost purely on oil. I mean, is there anything else? There have been folks in the United Arab Emirates, Dubai, and Abu Dhabi who have created a bigger economy than that. They don't just depend purely upon oil. They are, global business hubs now, and tourist destinations, so on and so forth. But for some of these countries, it's an existential threat. So, I mean, their economy ceases to function. So, look, here's what I think. It's still an oligopolistic market in oil production. There are only still a few nations that produce oil. Most nations are oil users on net, not oil producers on net. And so there is still significant market power there. Because Saudi Arabians and Russians and others haven't been able to agree, they have not been able to curtail that supply. And of course, demand right now is truncated by the crisis all over the world. And then on top of that, here's the biggie, the Americans are just so incredibly entrepreneurial and inventive that they've created all this new shale production capacity in oil and natural gas. So I would expect to see for the rest of our lives, for the most part, pretty low energy prices. Now you can come up with scenarios where that's not true, but the world is awash in fossil fuels, that kind of energy. And then on top of that, here comes solar and wind and other technologies. That said, the price right now, wherever it is at $23 a barrel on oil, wherever it is right at this moment, is unusually low. It'll be higher than that. And we're going to see, therefore, some bounce back in various shale formations across the United States, including the Permian Basin. You'll see some bounce back because they're the low-cost producers in the world at this point. So what can I tell you? The domestic U.S. energy sector grows. The global energy production sector may not, including the Saudi Arabian sector. As is often the case, I think the Americans are going to win this.
Another question that's come in, if I may, and that's, we've got a rapid demobilization of projects. You anticipate a V and enjoying the upswing of the V. What impact, two questions. Number one, what impact will that have on the construction labor force, where skills shortages were an issue a month ago? And also, what does that do to inflation? Do we have an inflation component in the recovery?
Right. So two things. One is about the construction labor force. I would say it's actually a great time to start a construction firm, believe it or not. It sounds odd, doesn't it?
Yes.
We're in the midst of this. But the reason I say that is because the issue with starting a construction firm previously, prior to COVID-19, was how am I going to recruit plumbers, electricians, glaziers, so on and so forth? I mean, there's none out there to be hired. And the apprenticeship programs aren't producing enough of them. And so how do I even start a business by cobbling together a workforce? But now you're going to see some free agents out there, right? You're going to see some folks who have been dislocated from their business. You're going to see some folks perhaps who need more training being dislocated from employment, right? Because one of the things that happened at the level of the contractor was that some contractors, because they've been so busy, because they've been setting records in terms of volume and backlog, they've had to hire some weaker performers, some people who really were not quite ready to do the job, but they need to get the work done. They're on they're contractually obligated to get the work done at this price by this moment. Some of those people are going to be let go. So, and they might be good workers potentially, but because everyone's been so busy, there just has not been enough time to really train them up. Now there's an opportunity to do that. And so what you're going to see is, for the time being, a period of deflation. Inflation is going to fall right now because demand is falling, and and there's just too much productive capacity out there. And I think construction wages are not going to rise the way they have been going forward, not for the foreseeable future. And then what you're going to see is, American entrepreneurship, rear its head again. It's a beautiful head again. And, the atoms will come and become molecules. Firms will fashion themselves, reform. Larger contractors probably get stronger. And that's part of this V process. So we're on the downside of that V right now. And the question is, the second part of the question is, do you see an inflationary period from that? There's so much surplus capacity right now in this economy. It's going to take a long time before we see some meaningful inflation. The Federal Reserve is going to have an awfully difficult time getting back to 2% inflation, and it hadn't actually gotten there even before the crisis by some measures. So I wouldn't worry about inflation in the near term. Certainly the Federal Reserve is not. You will see a V-shaped recovery in terms of GDP, but not necessarily in terms of inflation.
Another question, is it possible to use an equivalent of federal tax increment financing to allow people to extend the payments of debts incurred as a result of COVID-19? What are the chances of that?
Right. So I don't think so, because to use tax increment financing, you need a tax increment. You need something happening in the economy that creates this new source of revenues, and then government can utilize those new source of revenues to float bonds against. So those, but what new source of revenues do you have in this instance against which to float TIF bonds? It's not obvious to me, and maybe I'm misunderstanding the question. But what the government can do is help promulgate what I would call the great recalibration. And what I mean by that is that we're going to have to work together as a society to try to figure out how we can extend credit to each other. So if I owe my bank a mortgage, is there some way that I can have my mortgage payment delayed for 3 months without penalties and without interest? So that in 3 months when I can get back to work, I'll pay my bank. And you have to be careful with that, obviously, because you don't want the bank to begin to struggle financially. You don't want them to have a liquidity crisis, or a solvency crisis. But something like that, where we've got to be kind to each other and understand, hey, we're all in this together. And just as we're all doing, the hand sanitizing and staying 6 feet apart and all those kinds of things to try to get us through this together or separately, we also have to figure that out on the payment side of the economy, the great recalibration. And I think that's possible. And the federal government could help coordinate that behavior. And that's a very important thing. What is the new norm when people cannot go to work? How much time should I give people to pay their rent, their mortgage, their credit card payment, their auto loan? How much more time? And the federal government could lay out some guiding principles, if not enforce some rules on that.
Great. I'm going to interrupt for just a moment. We've got about 7 minutes left max, and we had some audio challenges at the very beginning of our webinar. And so I want to repeat some important information for those who may have encountered some difficulty with our audio. And while I'm doing that, Anirban, I would invite you to that chat box to see if there's some other questions that you would really like to bring to our attention. And then secondly, Anirban, I'd like to challenge you with this. If you had to leave us with 2 or 3 key points that we need to remember moving forward, what would those be? So think about that for just a moment or two while I review some important information. So number one, I wanted to thank the CII, the Construction Industry Institute, for our sister organization, if you will, a partner on many initiatives, for joining us and engaging with us in this webinar. If you wanted to learn more about them, construction-institute.org is their website. We thank them and we encourage you to explore their resources. Also, I wanted to tell you this is 3rd in a series of webinars that will be offered on Tuesdays and Thursdays. The target is 11 a.m. It's entitled Construction in Crisis, a Curt Response and What Owners Need to Know. The purpose of these seminars, again, is threefold, is to bring you perspectives, experiences, and resources. Our job, our goal, is to make you a better, more well-informed decision maker during these uncharted times with projects and with our personal finance as well. Almost immediately following this webinar, we'll be developing an email which will contain Anirban's bio, a complete slide set of what you've seen today, contact information for him, an announcement of how to register for the upcoming seminars, and some more information that we think you'll find extremely valuable. Again, the CURT office is open for business from 9 to 5. All the CURT staff is on deck. And if you think we can help you with anything during this difficult time, please call and explore what we have to offer. We have about 5 minutes left. I'm going to turn the mic back to Anirban for any questions that may have come in here in short course and any final comments he'd like to offer. Anirban?
Yes, I would just say, you said 3 or 4 things or 2 or 3 things. Preserve cash at all costs. That's the game right now. Preserve liquidity. lock up your strongest performers, because those are the folks who are going to take you to the promised land when the V shape, the better side of the V comes. This also means, though, that there's an opportunity to really think about your staffing model. And if you've taken on any weaker performers during the course of the lengthiest economic expansion in American history, one way to preserve cash, of course, is to no longer have them as part of the team. That sounds cruel. I understand that. But if your enterprise doesn't survive, what good are you to anybody? So, so think about that. If you're having any difficulties in terms of cash flow and so on, I would call the banker, or if it's necessary, call the insurance broker now. I would start a chat with them right now to talk about where you are, where they are, try to get that understanding, as opposed to trying to, not communicate with those folks. They need to know where you are, and they might surprisingly be, have tremendous forbearance in terms of debt repayments, and may actually be willing to extend that line of credit, expand it, so on and so forth. And that's part of that cash preservation process. And also, final thing I would say, and I think this is good advice, but you may disagree, do not book a cruise.
Although there are others who would tell you to do so, especially the cruise liners themselves.
That's right. That's right.
Absolutely. Anirban, one final question that came in here late. What other resources should we be monitoring closely, or news outlets or media? What are some other resources that you use, or perhaps some resources that you would invite us to clue into, a website, someone, any input on that, additional resources that might be available to us?
Yeah, I would say, one of the offices, our state departments of commerce, are fonts of information right now. They're really working hard, and also Small Business Administration, but they often work together. State economic development agencies and state departments of commerce. I happen to be chair of the Maryland Economic Development Commission, and I can tell you our Department of Commerce is working overtime trying to help small businesses, which is where a lot of the pain is right now, small businesses and their employees. And so that very valuable information about lending programs, so on and so forth. So it's not just the federal government that should get all the attention. Some of those states and localities offer some assistance too, and that can be very useful, especially for small businesses.
Any other private resources that you follow or monitor, recommend?
Oh, every single one. I mean, some of the economists at Morgan Stanley seem to be really good in terms of tracking the economic effects of this. Morgan Stanley, Goldman Sachs. I love Oxford Economics in terms of tracking economic information. I mean, that's what I'm built to do. I'm an economist. I'm trying to, and I create my own information, of course, as well for CFMA, ABC, and here today with Kurt. So yeah, those are the sources I look at in terms of getting where we are. Oh, and it would be nice to also get research from the World Health Organization, which gives updates on what's going on at Regeneron, Gilead. I know some questions about whether or not we can trust the World Health Organization, but there are, them and the CDC are important sources of information, and I would continue to look to them, because ultimately we want to know, when is that point on the V? What is that? Is that May? Is that June? Is it July? They'll tell us. It won't be the president necessarily. It won't be the governors necessarily. It'll be the folks from the CDC and similar situated organizations. They'll tell us when that point comes and when we can prepare for the ramp up.
That's terrific. And once again, I want to thank you for your generosity and sharing your insights and perspectives with us. And to the audience that remains, if you have unanswered questions, please get them into us, Rana, Rob, Kyle, Palmer. We'll try to get those to Anirban and get at least some response. Our purpose is to provide you the latest up-to-date information while we have these other two seminars planned. We do reserve the right to jump in with breaking news and displace one if we need to, with a new emerging issue that needs to be addressed. Next Tuesday at 11 o'clock, we're going to deal, of course, with the COVID-19 impact on safety. And then the following Thursday, planning during a pandemic. What do you do when your pants are on fire? What's the readiness to stop work? Bringing your resources again that we feel make you a better decision maker. If you have some suggestions for some future topics, please let Rana and Rob in particular know, and we'll do our best to meet your demand and resource you. Thank you very much. Take care of yourself, each and every one of you, and take care of each other. Thanks.